Hello everybody, welcome back to Valuation Investing, and today in this video I'm be going over UnitedHealth's earnings report, which they just reported earnings before the bell today. And as we can see here, this is after hours. The stock went down nearly to $265 per share. Right now it's near $275, but I think the stock is starting to go down a little bit more, but right now it's down about 2%. So not a huge drop in stock price, especially compared to last quarter, but we're going to be getting into the earnings report of UnitedHealth and then the financial health of this company, and then using my intrinsic value calculator to see if this sell-off gives us a good buying opportunity in the stock. So taking a look at UnitedHealth's earnings report, we can see here the company reported revenues of $111.6 billion, which did beat expectations barely by about $70 million. So at least they did beat on the revenue, but looking at the earnings per share, this came in at a lot lower than expected at $4.08 compared to $4.59 expected by the street. And the big problem here was the margins, where the margins have shrunk by a huge margin by going from 4.3% all the way down to 3.1% this quarter. So that is the big trouble with all these health insurance companies right now. There's a lot of medical costs going on right now, so their margins are getting weaker, stock prices are going down. Even though the revenue growth is continuing with all these companies, the biggest problem is these costs. And with that being said, we can see this right here with 80 to 85% is the target for their premiums that they receive for their medical expense ratio. However, UnitedHealth reported 89.4% this quarter compared to 84.8% in the first quarter. So this is a big jump, which kind of worries me. This is almost 5% increase in the amount of spending they have to do on their medical costs, and this is breaking their record of 85.5%. So this is a very high medical cost expense ratio for UnitedHealth that they've never seen before. So this is worrying to me, but the stock price is down nearly 60% since its all-time highs. So this could give us a good opportunity even though the company is weakening. And taking a look here, UnitedHealth now expects adjusted earnings of at least $16 per share. So they're not really having a good guidance. They're just saying at least $16. So that is a decrease of nearly 50% to where they thought previously $30 per share in 2025. So this has dropped almost 50% in their expectations for their earnings per share, where analysts actually forecasted earnings of $20.64. So at least UnitedHealth isn't doing too bad, but it is still a big decrease in their earnings per share. But the one thing that I really like about UnitedHealth right now is that they just bought back a lot of shares. And taking a look at common share repurchases, this is over the past 6 months, and this is the past 6 months from last year. So taking a look at how much they bought back, they spent $5.5 billion on buying back shares in the past 6 months compared to over $3 billion over the past 6 months a year ago. So, and with that being said, say they bought back at an average share price of $300, that means they bought back about 18 million shares in the past 2 quarters. So that's actually some pretty good buybacks from UnitedHealth, and this just tells me that they are a lot more confident in this company and that they're probably not going to go anywhere soon because they keep piling into cash to buy this company at a cheaper valuation. And this gives me more confidence in the company that they think that they're still going to excel in the future. And taking a look at the earnings per share growth rate of UnitedHealth, as we did in the previous video, we can see it's increasing over time at a pretty decent rate. But if we take a look at what they just reported, it would be right about here, nearly $4 of earnings per share. So this is a pretty big drop in their earnings per share for this quarter, but nothing to be too worried about, especially if you're a valuation investor and you're looking out into the future for 10 years. I think this is a slight hiccup in the company, and I don't think there's a big problem. And taking a look at the revenue, we can see, yes, it also did increase. So the only big problem with these companies is their medical costs, and I think in the future this will be resolved. So with that being said, I actually think UnitedHealth is in a pretty good position for the future. So taking a look at from last video, this is what I had to expect for July 29th. So my main big thing was margins will decrease by a large amount. I previously said 5 to 3%. So that's basically what happened. It's at about 3.5% or so, their profit margins. So I was basically right on that. And look, revenue is likely to be in line, which I was also correct on that. If revenue misses big drop in stock, we didn't have to worry about that because the revenue was in line with estimates. EPS is likely to miss due to 20 20 plus revisions and higher medical costs, with every other company missing on EPS. And I said if EPS beats stock rallies, obviously the EPS missed like I expected, and it actually missed by a little bit more than I expected, but nonetheless it still missed not by too much what other people might have been expecting, and that's probably why the stock isn't tanking by that much. Also, the EPS guidance is likely to be slashed, which was slashed from $30 per share from the beginning of the year all the way down to $16, at least 16. So at least the company is expecting more than $16 per share. Look for any statements on legal issues. So far there hasn't been any. So what I thought was going to happen basically happened. So this looked like a pretty good prediction by me, if I do say so myself, but nonetheless, this earnings report actually wasn't too bad, I personally believe. So with that being said, I'm going to be taking a look at the financial health of UnitedHealth, and as we can see here, yes, we can see 6 out of the 7-step stock analysis metrics are green. The only problem is the debt to equity ratio, which isn't even that bad, but in the future, we're going to see this decrease over time. Both the EPS is probably going to decrease, revenue growth is probably going to decrease. Then we're going to see the forward PE ratio increase and the PE ratio increase. So while the financial health over the past 5 years looks pretty good, in the next year, it's definitely going to weaken over time, so that's not good. But the one thing I do like is they are buying back a bit more shares, which does give more confidence in this company for me. So that makes me a bigger advocate to potentially invest in this company when the market opens. And with this being said, I'm going to be using my intrinsic value calculator to determine the fair value price for UnitedHealth and to determine what I would be buying this stock. So the first thing I have to do is do the future annual revenue growth rate, in which they're still growing this revenue at almost double-digit rates. And I think in the future, they can continue to actually do 8%. I previously said 7% in the last video, I'm pretty sure. But I think that they can actually get to 8% because their revenue is still going to be growing over time. They have a pretty big moat. They have a high switching cost value, meaning people aren't going to really want to leave this company because it's going to cost a lot more money and it's just harder to leave an insurance company. So I think the revenue is just going to continue to increase over time, and it's like a subscription-based model. So I think this revenue is going to continue to be resilient in the future at an 8% year-over-year growth rate. Now for the future profit margin, I think, once again, the future profit margin I think is going to be 5%. Right now they're at 3%, but I think this is a slight hiccup, and I think they're going to get back up to the 5 or 6% that they previously had. Now for the future P ratio, right now they're trading at about a 12 P ratio, meaning you're paying $12 for $1 of earnings per share. And in the past, they've been trading at anywhere from 15 to 25. And I'm going to be slightly conservative here at a 15 PE ratio. And with that being said, now I need to do the shares outstanding for UnitedHealth. And they've actually been buying back a little bit more shares over the past few quarters, which is actually giving me more confidence and giving us more return as an investor. So I previously thought they're going to be buying back shares at about 1%. Now I'm going to say actually 1.5% each year. I think that they can buy back shares. And with that being said, I get a future share price at $850 per share about, and the current price is at $274. I get a total annualized return of about 12%. And these aren't outlandish assumptions, I believe. These are pretty conservative, maybe not conservative, but I think this is the base case for this company, and I think this is definitely a reasonable valuation for this company, and I think you can make about 12% each year in the future. So with that being said, I think UnitedHealth, I would be buying if it got into the 250s. I've been saying this because if it gets to 250, it gets to 13%. So thank you guys for watching this video on UnitedHealth. Subscribe, hit the like button, comment down below, and see you.